Joining us right now is Darrell Cronk, Wells Fargo Investment Institute Chief Investment Officer. Darrell, good to see you. Thanks so much for joining us.
My pleasure, Marie.
What are you expecting from the bank earnings? Does J.P. Morgan tell us anything about the entire industry?
It should be a really good quarter for bank earnings as a whole. If you looked at the sector, you'd say earnings year over year are probably up 15%, second only to technology for Q1. Q1 is going to be a really strong quarter. I'd say there's three things you need to keep your eyes on as it relates to Q1. One is 9% earnings growth across the board, which is the best first quarter since 2011, and probably best quarter we've had in 6-7 years. Second, you've got revenue growth finally showing up probably around 6 to 7%, which is really good. Yeah, that's huge. We haven't had that for a long time. And lastly, typical of late cycle, you're seeing earnings narrow. So the sectors that are doing well are doing really well. The sectors that aren't are not. So
you say late cycle. Does that mean that this is not going to continue because we are seeing the consumer be strong? I mean, as you're saying, it's a great quarter for banks. Are you saying how much upside is there still to be had here then?
Well, unless you stop the yield curve from flattening, Matt, there's probably limited upside in the banks from here, right?
But you said the limited upside because of the valuation where the stocks are.
Correct.
Yep.
I mean, that's priced in right now. If you look at the 15%, and part of that's great year-over-year comps from Q1 of last year. So what you really need is the yield curve to steepen from here, and you need economic activity to pick up. The reality is Q1 is going to probably come in around 1% GDP growth. We need a solid Q2 and Q3 and Q4 to really make the bank engine move.
I mean, on this move, all the stars lined up. The minute Trump came in and he started saying we're getting rid of Dodd-Frank, we're reducing regulation, consumer confidence boosted, and all of a sudden, the banks flew. Rates until yesterday were moving up. Until Trump said he thought rates should stay low and the dollar should be weak. But outside of that, you need, everything kind of worked perfectly, and now I think the earnings will show it.
Yeah, I think you're right. You're getting a little bit of the fade back from kind of the Trump trade, right? We were up 12% since the election. You're seeing the weakening of the dollar. We had the dollar strengthen. You're seeing the financials fade, right, a little bit of late. So some of these actions that took place in November through, call it March 1st, when the market actually peaked, are starting to fade back on the prove it to us. Prove us you can deliver the action.
So what about that? I mean, the dollar's down again today because in the interview with the Wall Street Journal, the president said that it's getting too strong. What does that mean going forward then? Do you want to buy stocks here, or do you want to, what are you telling clients?
We would tell clients to hold tight here a little bit. We think $1 worth of cash today is more valuable than putting it to work at this moment in time. It doesn't mean, to Matt's earlier point, the cycle has fully ended, but we are certainly 8 years into it, right? So you've got to be more thoughtful about where you put money to work.
Darrell, if you take out some of the big sectors that ran with the Trump trade, the infrastructure trade and the financial trade, the market's just done okay. There's been a few sectors that have driven the trade. And Marie, often says, listen, we're up 12%. Isn't that amazing? Yes, we could actually be saying that being around the same level 6 months from today, and it would still have been an amazing run up 12%.
I completely agree. And we've been telling clients, look, 12% since the election, 20% year over year. If you go back to this time last year, be smart about this, right? I mean, make sure you're taking some profit as you go and trimming back.
Can you quickly just speak to the regulatory climate? Because it has come back. We haven't seen any action on Dodd-Frank. There's a little talk of even re-splitting the investment in consumer banks again. How uncertain do you think the climate is?
Well, I think the pendulum has swung on the regulation, right? So that's part of the tailwind, if you will, into the banking sector of this anticipation that regulation walks itself back, right? Whether that's Dodd-Frank, whether it's some issues around Volcker, whether it's even around some latest chatter around Glass-Steagall. We'll have to see how that plays out, Matt. I think just the idea that you're pulling some of that back, pushing forward a more healthy kind of business climate, let the economic engine run versus the regulatory overhang is a very positive
Helps the earnings.
I mean, Darrell, at the end of the day, the banks, even if you unwind a lot of Dodd-Frank, they are not going to go lever their balance sheet back to 35 times. They're not going to get into the whole prop trading. It's not going to be a wholesale change. They spent 5 years getting ready for this new regulatory paradigm. They're not going to totally shift it. What they need right now is literally rates to rise. And if rates rise, financials are going to fly. The problem is, as Darrell began, with the 2/10 so flat, there is no real movement for rates. And I think that the forward-looking curve is telling you they're nervous that even if the Fed rises, it's not going to do much for the yield curve.
As we turned the calendar year on this big rally, we were telling people, look, be careful of not getting ahead of your skis on equities. We think rates, we've had our 10-year at 2 to 2.5% for year-end 2017, when everybody else was moving it up to 2.75, 3%, 3.25, saying rates were going nothing but straight higher. We don't think so. There's still strong demand for treasuries, and if you look at where Treasury issuance is, 2017 will be one of the lowest years of Treasury issuance that we've had in several years. So the supply-demand dynamic's not good there. We think rates probably stay around this level or lower. Everybody else seems to think, inflation's going to tick higher, the yield curve's going to take a big jump. We're not so sure about that.
So do you still see the same demand for stocks that you see?
It's interesting, we're starting to see early demand for stocks, right? Fund flows have just started to turn of late, post-election. So when you look at kind of your traditional indicators that you'd be more concerned about, credit spreads blowing out, right? Fund flows walking back, right? M&A activity or IPO activity walking back, none of those are happening. So that suggests you're not kind of at the end of the cycle at this point. But you certainly have to keep your eyes on those types of things.
All right, we'll leave it there. Darrell, great insights from you. Thanks so much.
My pleasure.
Darrell Cronk joining us there. Coming up